this is the question, ladies and gentlemen. Whenever you're given a consolidation question, you shall always begin by reading the requirement. So required. So they want us to calculate the value of goodwill arising on acquisition of Shape Limited as at this date. Number 2, determine the value of interest in Jolty Limited as at this date. Jolty is a joint venture. Prepare consolidated statement of financial position for Pool Group as at 1st December 2024. Ladies and gentlemen, the question is here. We are told on 1st January 2024, Pool Limited acquired an 80% controlling interest in Shape Limited. Yeah, when the retained earnings of Shape Limited amounted to 3.2. So what are they telling us here, my good students? Before I start reading your messages, they are telling us here that Pool acquired Shape. Pool acquired Shape. Acquired 80% of Shape. So 80% really, in the absence of any information, 80% is too high. It's more than 50%. And there is nowhere they have told us that we have relinquished our managerial role. That, for example, we have bought 80% and told another group there that, hey, you guys, go ahead and manage it on our behalf. No. We have 80%, so we have a controlling interest. And if you have a controlling interest, then Shape becomes a subsidiary and the Pool becomes what here? Pool becomes the parent company. Yeah, so of importance will be what is the date of acquisition, right in full. The date of acquisition in this particular question, the date of acquisition in this particular question, yeah, so I hope you are able to see the paper April 2025, question number 3A. So the date of acquisition, yeah, you can see we acquired it on 1st January 2024. So we have here 1st January 2024. And then straight away, if you're a good student, you know that the next thing will be for you to write the date of the financial statements given. The date of the financial statements given down here, if you read this very well, we have the date of the financial statements here, right? It's here, 31st December 2024. 31st December 2024. 31st December 2024. So then, ladies and gentlemen, could you kindly tell me how many months did I stay with this subsidiary in the financial year? How many months did I stay with this subsidiary in the financial year? So the financial year, in this financial year, this is the year, it is ending here, we stayed with this subsidiary for a whole 12 months. So remember, number of months, NOM stands for number of months. Thank you so much. So up to here, ladies and gentlemen, somehow, are we together? Date of acquisition, date of financial statements? Are we together from the beginning of January to the end of the year? Those are 12 months. Together? Are we together? Yes. At least Tony has confirmed. Now from there, ladies and gentlemen, we continue. This is very, very important for all of you, AFR, FR, and BDS students. So, ladies and gentlemen, we are told here, there is, I'm looking for the group structure, so I'll not even read much. So I'll look at the interest both. We are told in this paragraph, Pool Limited also acquired 50% of the equity interest in Jolty Limited and obtained joint control. So Pool never stopped at Shape. Pool went straight away to acquire 50% interest in a company called Jolty. So then if you have acquired 50%, if you remember very well, Mr. 50%, that is what we call a JV. So this one here is a joint venture. Joint venture. Remember, below 50%, above 20%, in between 20%, up to 49.999 associate. Exactly 50%, a joint venture. More than 50%, a subsidiary. Don't forget, exactly 50% is a joint venture, and that will not scare me because I know that joint ventures are always accounted for under what we call IAS 28. Are accounted for under what we call IAS 28, which is that standard which talks about financial reporting for associates and joint ventures. So the way you account for an associate is the way you will account for a joint venture. So please tell me the date of acquisition and the date of the financial statements. Date of the financial statements is 31st, 12/24. This is the same, Date of financial statements is the same. So what I need to check is the date of what year is the date of acquisition. What I need to check is the date when we acquired this interest in Jolty. Pool Limited also acquired 50% of the equity interest in Jolty Limited and obtained joint control over Jolty Limited on 1st January. We are lucky. Coincidence. We are very lucky. 1st January 2024. Yeah, 1st January 2024. So 1st January, again, ladies and gentlemen, we stayed with this for 12 months. Number of months are 12. So once I've gotten this clearly, the group structure, I'll be able to go and read the question. If the examiner never told me to calculate goodwill, if the examiner never told me to calculate the value in the joint venture, then straight away I would have begun. After I do this group structure, the next thing, ladies and gentlemen, is for me to consolidate. Workings don't carry any marks. Those big workings, you keep on wasting your time there. You are taking a whole hour doing working. They never carry any marks. What carries marks? Let me be very, very honest with you. It is this. Let me show you what normally carries marks. What carries marks, ladies and gentlemen, let me be very, very honest with you. It is this. You can see like now the workings here for the net assets. Nothing, no mark given, here for group retained earnings. But when you come inside here, you will see, for example, if it's PPE, they're giving you a mark. Yeah, so however, in this particular question, this examiner was, in quotes, quote unquote, stupid. Yeah, he wanted us in this case here to do a lot of work. I don't like this kind of examiners. You can see in this case here, he wants you to calculate the value of what here? Goodwill. So here now you cannot run away. If you don't do goodwill, you shall lose 6 marks. If you don't do the value of interest in Jolty, you shall lose 2 marks. If you lose 8 marks, very, very bad. But if they were silent, then I would have gone for this directly. I would have gotten these 12 marks. Why am I telling you this thing of workings is so dangerous? I've been in this business of CASNEB exams, ladies and gentlemen, for so many years, and I know the moment you strive to be perfect in a group consolidation question, you will take 1.5 hours in that question alone. And that question mostly will have like a maximum 14 marks because there must be some marks for theory. So it has 14 marks and you have taken 1.5 hours, and trust you me, the only correct bit in your entire workings will be like what you did in the first 30 minutes. The other 1 hour has been spent on 0 marks, useless marks. A good student will appreciate that we are in this business to get marks. So what can I be able to garner in 37 minutes maximum? So if I know the shortcuts, then the better. But now this examiner has sandboxed me. He has told me he wants me to give them the workings for goodwill. I know before I get goodwill, I must get net assets. So in this case here, then I will come and rub here and tell my examiner that now I'm giving him the net assets because I can't get goodwill without getting net assets of the subsidiary. So net assets of the sub at acquisition and at reporting. At acquisition and at reporting. Net assets of the subsidiary at acquisition and at reporting. So now, my good students, whenever you hear of net assets, you great students of mine, what normally comes to your mind? What normally comes to your mind? Net assets of the subsidiary. Yeah, the equity components. Can somebody help me please share the question? Is there a good student who can be helping me do some of these great things, my good students? Please, we are in this together. We are fighting this war together. Somebody should be able to help Mwalimu. In this case here, share what here? Share this. So the equity components, I love what these students are telling me. But Mwalimu here, get the equity components of the subsidiary. Equity components. But let me ask you a question. Do you remember the name of our subsidiary? Do you remember the name of our subsidiary? What is the name of our subsidiary? It's Shape Limited. Shape Limited. So for Shape Limited, the equity components, remember equity is the share capital. So we have here share capital. We have share capital. We have in this case here share premium. Share premium. Share premium. And then of course we have retained earnings. Those are mandatory. Yeah, share capital, share premium, retained earnings. Those are mandatory. And then, of course, we're going to have what we call fair value adjustments, so retained earnings. But first of all, ladies and gentlemen, in this case here, let's work out these things together. And remember, we are getting net assets of the subsidiary, not the parent, not in this case here, a joint venture, not the joint venture here. So then what I will do, I will come right away here. Yeah, I'll come right away here, ladies and gentlemen. In this case here, we know that our SHAPE Limited, the subsidiary is here. So I want the share capital. So where is the share capital of SHAPE? You can see share capital of SHAPE, the middle one is 20,000. And remember, share capital and the share premium, these are your normal, usual accountants who are ever constant. They do not know how to dance. If you take them to a dancing floor, any accountant will be messing them up. Have you ever seen any accountant who knows how to dance, you guys? So the share capital in this case here, once you read one, it will always remain the same. It will always remain the same. Not dancing, constant, 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 constant. Share capital is always constant. So share capital, and please don't confuse, because I've always seen students taking like share capital of the parent. No, here we are dealing with the subsidiary alone, net assets of the subsidiary. So then come pretty fast here, ladies and gentlemen, and then you go for the share premium. The same case here with those accountants who don't know how to dance, share premium will also behave the same. Please don't pick the share premium of the parent here. No, no, no. It is share premium of the subsidiary. We'll never know how to dance, just like this accountant. It's always constant, seated in the same position the whole night like that. When I wanted to marry those old days, I tried hanging out with a few accountants. I never got any. Yeah, most of them really, they only think about debit credit. We shall overcome. We shall overcome. So from there, come and give us now retained earnings. So retained earnings, ladies and gentlemen, retained earnings, what do we have for retained earnings? Normally changes, because retained earnings will be given like up here. You'll be told here, on 1st January 2024, Pool Limited acquired an 80% controlling interest in SHAPE Limited when the retained earnings of SHAPE were 3,200. So remember, I'm cutting the 3 zeros. Oh, yeah. They were 3,200. And when I go to the financial statements, retained earnings at reporting here, you can see retained earnings for SHAPE is 6,100. Retained earnings for SHAPE is 6,100. Retained earnings for SHAPE is 6,100, like that. Remember, we are doing this net assets at acquisition and net assets at reporting. So up to here, ladies and gentlemen, somehow are we together really? Somehow are we together? Somehow are we together? Great, great. Thank you so much. I upload, somebody has been uploading the question. Somebody should be able to continue doing that good Lord's work. Please continue just uploading. Now from there, ladies and gentlemen, I'll be able to read through. You know, your additional information is not like ACCA. Your additional information, even if it's advanced FR, will go to note number 6 or 7 at most, even if it's BDA. Your additional information is so little, you'll be able to tell. So like now, number 1, at the date of acquisition, the fair value of SHAPE Limited, net assets approximated their carrying amounts, with the exception of some plant, whose fair value was 1,000. I'm cutting the 3 zeros because of, these are in shillings thousands. So even when I read here, I'm cutting 3 zeros. 1,000 above its carrying amount. Yeah, so you can see a property, plant, and equipment item here, which was revalued, which was revalued, which was revalued, which was revalued. So the revaluation, so we have fair value adjustment. Oh yeah, fair value, right in full. Fair value adjustment, which is an uplift, is 1,000 and 1,000. This is your usual accountant who never knows how to dance. It's ever constant. If it's a fair value uplift, then we will have to do the fair value adjustment, depreciation of the same. So the depreciation will be the 1,000 here. We divide by the useful life. We divide by the useful life. Do we have useful life? Yeah, you can easily cram these even, very, very easy. So useful life, ladies and gentlemen, the useful life they're telling us, at this date, the plant had a remaining useful life of 5 years. So you divide this by 5. You divide this by 5. And then remember, we had stayed with this subsidiary for how many years in this financial year? Yeah, since we bought it to today, how How many years are we talking about? 1 year. So just for your revision, so in this case here times, because depreciation has to be time prorated, times 12 over 12. So this will give us basically 1,000. Can I write depreciation here when this fair value is brand new? Can I write depreciation at acquisition? No. The depreciation in this case here will be written here. It's 1,200, sorry, 200. And now remember, this is loss in value. This is loss in value. This is loss in value. Now from there, do we have any other thing that we have left out? Do we have any other thing you have left out? Yes, UPS. And remember, we normally talk of UPS. When do we normally talk of UPS? Do you know the condition? Do you know the condition whenever we talk of UPS? UPS, we normally talk of UPS. When do we normally talk of UPS? Remaining stock, I like that. Is it uplift, Lillian? Is it called uplift? I know you are really trying, but do we call it an uplift? When it is subsidiary selling to parent. What Lillian is trying to remember is the concept of what we call upward here, upstream. When the sub sells to parent. When the sub sells to parent, remember, this is how this thing looks like. So we have in this case here, the parent up here and the sub down here. So when the sub sells to the parent, we call that one an uplift. And if it's an uplift, then we must, in this case here, do an adjustment. Now, do you remember the formula for getting this UPS, you grade students? Do you remember the formula? Do you remember the formula of getting UPS, you grade students? We normally take the profit margin, profit margin, but this examiner has given us profit markup. This examiner, first of all, we read this note here. Not this one of goodwill, this one here. During the year ended 31st December 2024, Shape Limited, which is the subsidiary, sold goods to Pool. So I can see an upward trend. Pool is the parent, Shape is the subsidiary. Yeah, the goods in this case here were worth 4.5 at a markup of 25 over 100. So remember, my good students, this is dangerous. So whenever you hear of markup, you see if markup is A over B, then margin has a bigger base. Margin will be A all over B plus A. Sijui kama mnakumbuka hiyo. Remember this. Is there somebody who is able to remember this? Such that if you tell me that markup OA is 25%, then I know margin is blessed. Margin will be 25 over 100 plus 25, which will be 25 over 125. I don't know whether we are still together really. Yeah, the concept of adding. Yeah, the concept. I don't know whether we are still together. I don't know whether we are still together. Yeah. Asante sana, Joseph. You will never forget that. Yeah, very good. I can see you guys. Mko na language. Naona nyinyi mko na language. So they have given us, ladies and gentlemen, they have given us what we call markup. Yeah, which is 25 over 100. And as we want margin. So for UPS, we shall use the margin. And the margin, we have gotten margin of 25 over 125. 25 over 125 times remaining intra-sales. Times risk. So the remaining intra-sales, what do we have here for remaining intra-sales? Oh yeah, skiza. 1/3 of these goods was still held by Pool by the reporting date. 1/3 of this 4,500. Yeah. So in this case here, we have 25. This is times remaining intra-sales. And remember, the total sales between the group members were 4,500. But now 1/3 were left. So are you able to give me this final answer for unrealized profits on stock? Unrealized profit on stock, or what somebody calls UPI, unrealized profits on inventory? 300, isn't it? Do I write 300 here? Do I write 300 here? Do I write 300 at a... No, nothing there. So it shall be, and because it's fake profit in stocks, we shall subtract. And that is it, ladies and gentlemen. But the most important thing is for us to remember UPS upstream, even from the word up. UPS upstream, the subsidiary selling to the parent. If it was downstream, then this would not have fallen under net assets of the subsidiary. It falls under net assets of the subsidiary because the subsidiary is the one that earned the fake profit. The one that earned the fake profit. Abracadabra, is there somebody who is able to give me the total net assets at acquisition? Anybody who is able to give me? Yeah, wait, why are you multiplying by a third? Yeah, you see, always, this is about what here? Remaining stock. If they were able to sell these goods to third parties outside there, then the profit would have been realized. What we haven't yet realized is what is within our stock. So you can see here limited at a markup of this, and then 1/3 of these goods were still held. Thanks for asking that question. Thank you so much. And I hope you've been able to understand. So they're giving me a figure of 26,200. 26,200. How about at reporting? How about at reporting? How about at reporting? At reporting, oh yeah, 28,600. From there, you know what will follow is what we call the post-acquisition profit. Write this in full. Papa, post-acquisition profit. When your net assets grow with time, then you get what we call post-acquisition. So post-acquiring, we have gained profit. So it will be 28,600 minus 26,200, which gives me how much, ladies and gentlemen? The PAP, post-acquisition profit, is 2,400. Is 2,400. Of course, I know, ladies and gentlemen, that I'm really moving with a high speed, but it's because of the 1 hour. I only have 1 hour. Now I have 30 minutes to go. But somehow, are we able to connect even with that high speed? Because the essence here is that even if I'm moving quite fast, you should be able to follow. Are you able to connect? Are you able to connect? Are you able to understand? Thank you so much. Now let me post that question and ask the BDA students who are around. Let me ask the BDA. Now, if you are a BDA student, are you able to cope up with our speed? Even if you are writing first of all by hand and then later you'll be able to type. BDA ninjas, are you able to cope? Thank you so much. That is so encouraging. Then we shall be able to continue. Now, once you get this post-acquisition profit, you leave it there. But please take note of this. The net assets at what year? At acquisition. The net assets at acquisition, I know this will be used in my next working. My next working is goodwill. What this examiner has told me to calculate in part A of this question, they want me to give them goodwill. How do I get goodwill? How do I get goodwill? To get goodwill, you look at consideration paid by parent. Paid by parent. So this paid by parent, there could be a cash element and there could be deferred consideration. Deferred consideration. So unaziongeza namna hiyo, unapata hapo. Figa namna hiyo. Yeah. So that is the consideration paid by the parent. Alafu unakuja unasema consideration, consideration paid by who? The parent never paid, never bought 100% of this company. The parent in this case here, ladies and gentlemen, left some percentage, of course. Like here we bought 80% of the subsidiary, so we must have left 20% to be bought by someone else. So consideration paid by NCI, please write in full. This is non-controlling interest. This is non-controlling interest. This is non-controlling interest. This is non-controlling interest. Unaongeza namna hiyo. Hello. Unakuja hapo unasema sasa total consideration. What has been paid? Total consideration. Total consideration. Unaongeza namna hiyo. Halafu unakuja unasema less net assets. Less net assets at acquisition. Hivyo ukisubtract unapata goodwill at acquisition. Goodwill at acquisition. Alafu unajua goodwill, just like any asset, it is subject to loss in value. Loss in value of this intangible asset is what we call what here? Impairment. Impairment loss. So impairment loss namna hiyo una subtract, unapata goodwill at reporting. You get what we call goodwill at reporting. Once you are able to get this figure, not figure, but I mean, once you're able to finish writing this format down, give me a Y there. A Y there for yes. A Y there for yes. Thank you so much. A Y there for yes. Thank you so much. So now we have everything. We have everything. But again, remember that this deferred consideration, it must be done what year? it must be present valued. If there is a consideration that we have promised that we shall pay later. Just like, for example, when we marry a Kikuyu lady, Kikuyu people are very, very good in terms of dowry. They don't believe like what most of us believe in. Most of us, we believe in that this is my daughter, she's a banker, she has a master's, give me 3 million shillings before we talk about anything else. Kikuyu, there will be deferred consideration. Sababu kwa Kikuyu, dowry hapana isha. Dowry hapana isha. So yeah, uko mbele, you discount it, you bring it to today's terms. Yeah, inakuwa present valued. Inakuwa present valued. All right. So sasa, turudi kwa hii question yetu. Goodwill. We are overcoming, oh yeah. So kija hapa, wewe utaki kwenda mbinguni, unaenda kwa next aje? Sasa unaambiwa hapa paragraph number 1. Remember, goodwill is for the subsidiary. Don't start calculating goodwill for joint venture and the goodwill for associate. Don't do that. Those were old standards. So come here. On 1st January 2024, Pool Limited acquired 80% controlling interest in SHAPE. SHAPE is the one that we're interested in. When the retained earnings of SHAPE was this. The acquisition consideration consisted of an immediate cash payment, 12 million, paid by the parent. Parent is, in this case here, Pool. And then we have on 1st January 2024, and a further cash payment of 12.1 million deferred until future. Oh yeah. And the cost of capital is 10%. Cost of capital is 10%. So not a problem. So what I will do, I will come here, right? Consideration paid by parent. Consideration paid by parent. So we have the cash. Cash wamesema ni 12,000. And then we have deferred consideration. So deferred consideration wamesema ni 12,100, but I shall discount this using this formula. 12,100, I'm cutting the 3 zeros. 12,100, yeah. And then remember, this R is the cost of capital. Remember, when you are making this a denominator, the N will be positive. If you take this up, now you introduce the negative. So then this will be 12,100. You divide this by 1 plus ROE is the cost of capital. But in this case here, remember, we don't do this deferment forever. We are deferring this payment up to when? Remember, we are making this promise to pay on 1st January 2024. And we shall be paying at the manager on 1st January 2026. Hiyo ni miaka ngapi? Miaka ngapi maninja? How many years are we talking about? In between here. Yeah, we've made a promise to pay it by this date, and we started the transaction. So 2 years exactly. So raised to power 2. Raised to power 2. Or you say, if you want, you can say 12,100 times present value interest factor. Yeah, which will be 12,100 into 1 plus R raised to negative N. Kwa hivyo ungesema 12,100 times 1.1. Same thing. Same thing. Are you able to give me this amount, ladies and gentlemen, here? Deferred consideration, oh yeah? Deferred consideration, I'm so sure you have gotten your concept there. So the deferred consideration, wanasema ni 10,000, right? 10,000. Thank you so much. So then in this case here, we have a consideration paid by the parent to be 22,000. 22,000. Hapo iko sawa kweli? Iko sawa kweli hapo ama bado? Iko sawa Ushapata kitu ambacho build on. Now remember, you never paid this, bought this company 100%. Kuna consideration paid by NCI. So you look for NCI information. So consideration paid by NCI. So consideration paid by non-controlling interest. And the additional notes, yeah, NCI is 57. They're telling me, Mwalimu, NCI is 5,700. These ninjas are very, very fast than even Mwalimu. So wanasema hapa information ya NCI, my good students, this is why I love these topics. You know, you may not have understood this during the normal class. You may not have even attended anybody's normal class. But these few sessions, like for example, I do this one. When I come to AFR, of course, I'll be able to do like piecemeal acquisitions. And then I do cash flow statements. with some little theories here and there, you'll get yourself passing. Yeah, you'll get yourself passing. Just be very keen. This last minute revision, the low hanging fruits revision program is really very important. Many things start making sense now. I'm so sure even some of the things I'm talking about, you're wondering, how comes I never understood this when I was being taught in the normal session? Many things make sense now. They fall in place now. So we are told here, Pool Limited measures goodwill under NCI using the fair value method. The fair value of the NCI was 5,700 at the date of acquisition. You're right. So please give me the total consideration. Total consideration. So total consideration, when you add the two, we are getting 27,700. 27,700. Then we come and less. We less net assets at acquisition. Net assets. Are you able to see the net assets at acquisition, ladies and gentlemen? Are you able to see the net assets? Remember that table we did? That table we did, it had net assets 26,200. So subtract this, my good students, to give me goodwill at acquisition. Give me goodwill at acquisition. How much do we have there? If you take this and this, so the premium over and above that we paid is 1,500. Then you come and less impairment loss. You less impairment loss. They have given us a policy for impairment loss in goodwill. They have given us a policy for impairment loss in goodwill. They've told us, ladies and gentlemen, here, impairment review performed on 31st December 2024 revealed that goodwill arising from the acquisition of Shape Limited had been impaired to the extent of 10%. So 10% kwisha. 10% kwisha. So 10% of this 1,500, this is 150. Ukisubtract hapo, tuko na goodwill at reporting. Goodwill at reporting. So goodwill at reporting, how much are we talking about, ladies and gentlemen? 1,350. So now if you do it this way, you have your 6 marks. Goodwill at reporting, you have your 6 marks like that. And of course, I've already shared, I don't know whether I've shared these answers. It's good I share the answer so that as I move with speed, you guys will be able to, you can see goodwill, 1,350 at reporting, what I shall report. Yeah. Ladies and gentlemen, we come here right away to part B and know how to basically write your question sections. Now we are going to part B, where they want us to determine the value of interest in Jolty Limited as at this. Who is Jolty? Jolty is a joint venture. Jolty is a, can I rub this, my good students? Can I rub this? Ah, great. Yeah, great. Thank you very much. So they want me, ladies and gentlemen, to come here and they give them the investment in JV. Investment in JV. So investment in joint venture, IS 28, you shall always value associates and joint ventures in the same way. It's called equity approach. Equity approach. You give us the original investment. You give us the original investment. The original investment. In this case here, you add share of PAP. PAP of JV, not a subsidiary of the joint venture. And then you less impairment loss. Which impairment loss? For the joint venture or for the associate? Or the associate like that. So you less like that, and then you'll be able to get, ladies and gentlemen, the investment in the JV. Investment in JV at reporting. At reporting like that. Kwisha maneno. Just as simple as that. The equity approach, the profits model, profits and any losses. Equity approach, one line. One line. Oh, somebody was saying no when I had already rubbed. Please don't hate me. Yeah, you'll be able to get this solution which has got this. Sorry for that. How about this format? Can I rub the format now? Can I rub the format? We have 20 minutes to go. Wow, and I have another class, AFM, at 8 p.m. So I can't stretch a little bit like I did during lunch hour. You must finish this now. It's now or never. It's now or never. So we are through with this. So then pretty fast, go ahead and give us the original investment of the JV. Original investment of the joint venture. Are you able to see it anywhere? Original investment of the joint venture. Original investment of the joint venture. Yeah, we're told here. The joint venture is called Jolt. Pool Limited also acquired 50% of equity interest in Jolt and obtained joint control over Jolt Limited on 1st January 2024. The purchase consideration comprised an immediate payment of 10 million. Yeah, so in this case, the original investment of Jolt joint venture is 10,000. Yeah, then you add the share of, in this case here, post-acquisition profit of the JV. Here, remember, we track retained earnings. Don't forget, hii sio ngumu kama ile ya kupata PAP ya subsidiary. Hapo unaangalia, tukinunua, retained earnings ilikuwa mbesha shiga na ilikuwa 2,500. The retained earnings ilikuwa 2,500. Na hii Jolti, by the end of the year, the retained earnings were worth 3,800. So I can see the growth, which is the post-acquisition profit now, will be 3,800 minus 2,500. Oh, yeah. So we have here, we track retained earnings growth. So we have here 3,800 minus the pre-acquisition. But again, remember that we only bought 50%. It's Mr. 50%. It is Mr. 50%. So is there somebody who can give me this share of post-acquisition profit for this joint venture? Don't bring issues of the subsidiary here. Don't bring issues of the subsidiary here. So then this one will end up giving us how much, my good students? 650. So what have we said? Somebody is telling me to repeat this. What have we said about share of post-acquisition profit for the joint venture? We track the movement in retained earnings. When you bought this joint venture, it had retained earnings over how much? When we bought this joint venture, it had retained earnings. You can see here. Pool Limited acquired this Jolti. The retained earnings at acquisition, this date, was what, 2,500. How about retained earnings in Jolti's hand at the date of reporting, during the financial reporting date? So you can see retained earnings here for Jolti is 3,800. So the profit here will be 3,800 minus the 2,500. Take 50% of that. Take 50% of that. I hope that's a little bit clear now. Yeah. So then that gives us how much? 650, like that. Then you come and less the impairment loss. Less impairment loss. Usikachukue kale ka 150 wewe, in impairment loss of the joint venture, which the examiner has told us that the joint venture had not been impaired at all. The examiner told us that. The examiner told us that. Impairment review performed on December revealed that goodwill arising from the acquisition of Shape Limited had been impaired to the extent of 10%. The interest in Jory Limited was unimpaired. So impairment loss is 0 for the joint venture. Remember, Jolti's joint venture 0. So is there somebody 10,000 plus this 650? This gives us 10,650. So this is Jolti at reporting. Jolti at reporting date. So this is what we shall take to our statement of a financial position. So our statement of financial position, ladies and gentlemen. Sorry, let me just stop sharing this so that I can come and share properly. Yeah, so ladies and gentlemen, then that is it. You come here, you can see how now, you see now we are done with part B. Now we are in part C. So part C, you can see interest in Jolt Limited is 10,650. So we have this and this. Yeah. So then we go to part C, where now they want us to do what here? To consolidate. So now part C, we are consolidating. Can I rub this? Can I rub this? Can I rub this? Stanley Mosioka, great. I can see you here again. And we rub this. So now they want us to consolidate. Oh, yeah. How do we consolidate? Very easy, marks now. So we'll be able to come here and call this by the name of the group. The name of the group goes by the name of the parent. So we call this pool group. Statement of financial position as at whatever. I know those things you're very good with them. So we start by accounting for our assets here, non-current assets. So non-current assets, what do? We start with our property, plant, and equipment. And don't forget, ladies and gentlemen, that whenever you are consolidating, remember this is consolidate or group statement of financial position. Whenever you're consolidating, you take the figures of the parent plus figures of the subsidiary. We always consolidate parent plus subsidiary. If there is anything to do with a joint venture or even an associate, this one we don't consolidate. We only consolidate cousins. Yeah, members of what here? The same family. Who are and who? It is parent and subsidiary. Parent and subsidiary. Uskaileta hapa figures za joint venture. Uskaileta figures za joint venture hapa na figures za nini? Na figures za yeah. So in this case, no. Let me come here. Yeah. Great. So come here, ladies and gentlemen. Now we are consolidating. Please, you are taking, if it's PPE, you are taking the parent, which is pool, 36,400. So you say PPE is 36,400 plus, in this case, ladies and gentlemen, shape. Shape is 18,500. Shape is parent. You can't say plus jollity figure. Jollity figure is not a cousin. 18,500. Yeah, then we ask ourselves, in the statement of net assets, do we have any fair value adjustments of plant in the net assets? Do we have any fair? You go to your net assets, look at fair value adjustment. You remember we had a fair value adjustment, right? We had a fair value. Yeah, JV is a bad omen here. Don't touch JV. Yeah. So in this case here, we had 1,000, isn't it? It was an uplift. It was a revaluation gain. So you say plus 1,000 minus, still in the net assets, we have that depreciation of 200. So please give me this figure. Pretty fast, pretty cool. Give me an answer here. Aha. So Stanley ananipatia figure ya 55,700. Iko sawa kweli? 55,700. Iko sawa? Aya. Kutoka hapa, do we have any important futuristic assets? Yes. Assets that will be able to span more than a year. Goodwill. Goodwill, already you guys gave me a figure. Do you remember the figure ya goodwill? Oh yeah. Goodwill ilikuwa ngapi? 1350. We also have an investment in JV. Just like how we do it with the associate. So investment in JV, you guys gave me a figure of 10,650 like that. Kuisha maneno. Tuende kwa current assets sasa. Woye. Current assets. Tunaanza na inventory. Tuna consolidate sasa. Unachukua inventory ya parent plus inventory ya subsidiary. Inventory ya parent, woye. I can see 21,400 plus 13,000. 21,400 plus 13,000. Usikaseme hapa plus 10,200 plus 10,200. Hiyo itakuwa umechukua mashemeji. Hapana, cousins only. Parent and subsidiary. But now remember, within this inventory, we have some fake profit. Yeah, from your net assets. Do you remember that fake profit, what we called UPS? Or even if it wasn't there, UPS has to be subtracted either way. So UPS ilikuwa inakuja ngapi? Oye. UPS ilikuwa inakuja 300, isn't it? Minus 300. So what figures do we have, my good students, here for inventory? 24,100. Is that okay? 34 or 24? Where? Niki. Ni 34,100, eh? 34,100. Thank you so much. 34,100. So abracadabra, kuja hapa straight away, ladies and gentlemen, andika namna gani? Kuna receivables. So receivables, what do we have here? Very easy consolidation. So for receivables, ladies and gentlemen, we have for the parent 18,500 plus, in this case here, 11,400. Yeah. But now remember, receivables, we must always seek to deduct the fake receivable. I normally give you a very simple example. So in the morning, my wife tells me, mwalimu nipatie 100,000. Nikishampatia, Do you think I should be booking that receivable like I will never receive the money as the husband? Do you think I will ever receive that money? No, that's a fake receivable. The same case with these group components. Parent and subsidiary, they should never, in this case here, book any form of receivable in between them during consolidation. Any intra owings shall always be subtracted. So in this case here, if I had given my wife 100,000, not unless you are another one. As a husband, you must forgive. That is how it is. If the lady, of course, was to give me money and I have to, of course, pay back that money happily, even with interest, isn't it? That is how life was created. Otherwise, hamtaishi. Itakuwa international disaster. Yeah, my wife always calls me mwalimu. Itakuwa, yeah, forgive and forget. So do we have in this case here, ladies and gentlemen, unasema umecheza vieta, Sasa hapa, do we have any intra owings? Yes, hapa. During the year ended 31st December 2024, Shape Limited sold goods to Pool worth 4,500. So the sale was 4,500. At a markup of this, a third of these goods was still held by Pool by this date, and the balance payable was still outstanding. So what is the balance payable between these group members? It is the whole 4,500. Tukimaki hii, wanafunzi wengi wali confuse, wakaanza kuchukua a third. They never told us that a third was paid. Or 2/3 in this, no. In this case here, they are telling us that 2/3 of the goods had been sold. But still the whole 4,500 owing is still outstanding. So one company is saying, I've sold goods worth 4,500. He expects to receive the 45. So that 4,500 is fake. So I hope this is clear. Like here tukikosea kwa exam, so what? We don't want you to get everything. I'm not teaching you here to be perfect. I just want you to get an award, but not to be perfect. Yeah. So apart from receivables, do we have any other thing? Yes, we have cash and cash equivalents. So cash in a free mark. So please cash, what do we have here? 12,700, 12,700 plus 12,700 plus 8,100 plus 8,100. So cash, of course, cash ina mambo mengi, but at times they'll give you cash in transit. If they give you cash in transit, where do you bring cash in transit? If they give you cash in transit, you shall create a new row here for cash in transit. So there is no much. So please give me these figures. So receivables. Receivables, how much? 2,800. We have our answers, by the way, even I don't have to wait for your answers. The answers are here. Yeah. So trade receivables, I hope you're able to see 25,400. Cash and cash equivalents, I hope you're able to see 2,800. Is that okay? Is that okay, ladies and gentlemen? And then please give me the total loss. You can even see the figure for totals. We don't award any marks. In an exam, even myself, I will never be able to get these figures for total. No. So we go to equity and liabilities. Can I go to equity and liabilities, my good students? Can I go to equity and liabilities now? Can I go to equity and liabilities? Yeah, thank you so much. So we shall be able to finish. We shall be able to finish. For my case, I'll wrap, but you guys are continuing. So equity and liabilities, what do we have? So we have equity. First of all, we start with equity, where we start with share capital. Share capital. So share capital, we take the one of the parent only. Free mark. So share capital parent only. Thank you, Keziah. So in this case here, parent only. Yeah. So share capital, you take the one of the parent only. So you can see here for share capital parent, the first one, 50,000. You write 50,000 there. Then we have share premium. Again, parent only, free mark. Share premium, parent only, free mark. So in this case here, share premium, parent only. What do we have here? 5,000. 5,000, parent only 5,000. And then, ladies and gentlemen, of course, we have what we call retained earnings. Retained earnings, I'll be able to do a working. What else do we bring to equity? Permanent source of capital, what else do we bring to equity? What else do we bring to equity? NCI, isn't it? NCI. NCI can do the working pretty fast. NCI sio ngumu sana, I can do the working very fast here. NCI si kadiambo. NCI ni karahisi sana. Sababu utachukua NCI at acquisition. NCI at acquisition ilikuwa pesa ngapi? Hii nitapata haraka sana. I can see my AFM class is starting, but NCI is important to just get it. It's very easy to get it. Oh yeah, NCI is the figure that I have in goodwill. That figure that I have in goodwill is the NCI at acquisition. Mnakumbuka? It was 5,700. That figure that I have there, 5,700. So we give them share of PAP. Share of PAP, post-acquisition profit. Ya subsidiary. Pale kwa net assets. PAP, mulipata PAP ya ngapi? Was it 2,400? Oh yeah. Tulipata PAP ya ngapi? Oh yeah. Tulipata PAP ya ngapi? Pale kwa net assets ya subsidiary. Tuwagawie kakitu. Was it 2,400 that net assets PAP? Yeah, 2,400. Yeah. Hii inakuja 480. But remember we made some losses. The group made some impairment loss. So when they make some impairment loss, we also share with them. Remember them? We have 80%. Them in this case here, they have 20%. So, and you remember very well, impairment loss of goodwill was 150. So 20% of 150 gives us what? Is it 30? 20% of 150, I believe, is 30. Is that okay? 20% of this should be 30. So please come and subtract. Give us NCI at reporting. Give us NCI at reporting. How much do we have there? NCI at reporting, abracadabra. NCI at reporting, abracadabra. You take this, give them the profit. You're adding profit. You subtract losses. 6150. Oh yeah. So NCI here is 6150. So now we are through with the equity. Now we go to non-current liabilities. We go to liabilities. We start with non-current liabilities. So non-current liabilities, what do we have here, my friends? Non-current liabilities, what we have is really easy peasy. So you can see that it's only one. Now, long-term borrowings. So we have the borrowings. I'm getting very many marks. So we have the borrowings. So borrowings, what do we have here? 18,000 plus 8,500. How much do we have, ladies and gentlemen? 18,000 plus 8,500. Oh yeah. 18,000 plus 8,500. Oh yeah. How much do we have? Akisa niko peke yangu, but I will overcome. Niko peke yangu. Free mark, yes, 26,500. Hakuna adjustment hapo. And that is the only non-current liability. So we go to current liabilities. So current liabilities, what do we have there? Payables. Current liabilities. So we have payables. Payables. So payables, what do we have here under payables? Oh yeah. Payables, what do we have here under payables? I can see 16,300. 16,300. 16,300 plus 90 plus 40 plus 9,500. But do you remember the fake payable? Do you remember that fake payable, madam wangu kwa ile side ingine? Kijaribu kumwambia nipe pesa yangu ananiambia ngo, sikupei. Sikupei, sikupei, sikupei. That fake payable ilikuwa ngapi? Minus 4,500, isn't it? Minus 4,500. Wewe nimewashinda sasa, hata wafuati sasa. Kwa hivyo inakuja 21,300, eh? Inakuja 21,300. Is that okay, ladies and gentlemen? Yeah. Payables, we can check with this answer. You don't even have to struggle writing quite a lot. I just need to give you this marking scheme. Yeah. So in this case here, you can see the payables. You can see payables, 21,300. And then come and give us current tax. You can see current tax. Very easy. Current tax, what do we have there for current taxation? Current taxation, what do we have there? Current tax, sorry, I should have shared this one. So current tax, ladies and gentlemen, what I have is this one. Current tax, you can see 8,500 plus 4,900. Please add 8,500 plus 4,900. So current tax, hii hakuna adjustment, hii ni rahisi. Hii hakuna adjustment, oye. Hii ni 85 tax, hakuna adjustment. That's deferred tax, hakuna adjustment. Munapata mbesa shigana. Mbesa shigana. Mbesa shigana. Mbesa shigana. Yeah. So tax, and gentlemen, what do we have there for taxation? What do we have here for taxation? Current tax, my good students. So current tax, my good students, what we have here, I'm being given a figure, yeah, current tax, 13,400. Is that okay? 13,400. From there, ladies and gentlemen, we have another liability that so many students will forget, what we call deferred consideration. Ukiangalia deferred consideration, after being given that loan, after the loan, if you remember the loan was how much? Deferred consideration, the loan was how much? How much was the loan? How much was the loan? Yeah, deferred, was it 10,000? Was it 10,000? The loan was 10,000, isn't it? So 10,000 plus the interest. The interest is 10,000 times 10%. And remember, we listed this with this for just 1 year. By the end of the year, the money has not been paid and the interest thereon has not been paid. So this gives us 11,000. Is that okay? 11,000. Is that okay, ladies and gentlemen? 11,000. 11,000. Don't forget that deferred consideration, you take the present value, 10,000, and then you give us the interest on it. Yeah, the interest on it. So then what do we have, ladies and gentlemen, my good students? So my good students, what I have here, the deferred consideration has already been provided. This one is a liability. Yeah, deferred consideration, 11,000. So remember, the total equity and liabilities should be equal to what? Should be equal to total assets, isn't it? If you remember the total assets there, the total assets, ladies and gentlemen, were 148,000 there. Total assets were 148,000. The total assets here were 148,000. So it means that all this must also add up to 148,000. So if you want to get the balancing figure, which is retained earnings, you take 148,000, you subtract this, subtract this, subtract this, subtract everything. You'll be able to give me retained earnings. Retained earnings working, you'll be able to get it. Retained earnings working, you'll be able to get it. Are you able to get it, my good students? Anybody who is able to do the abracadabra, subtract that very fast. Yeah, they are getting 14,650, isn't it? That is the easiest way of getting retained earnings. That is the easiest way of getting that retained earnings figure. Let it be a balancing figure. This retained earnings figure, let it be a balancing figure. Ladies and gentlemen, you can see I've moved with lots of speed. I've moved with lots of speed. And I believe you have been able to pick some interesting stuff out of this. But ladies and gentlemen, in an exam, I can assure you, I've been an examiner before. Of course, nowadays I'm not an examiner. If you are that perfectionist who will start looking for retained earnings, I can assure you that I will be able to teach you, again, the same paper. A good student is that student who is a maximizer. You maximize on marks, you keep on moving forward. You only have how many minutes? 37 minutes. If there is a student who did a FAR some time back and they failed, who are now in BDA or wherever, you will bear witness with me that you failed simply because, ladies and gentlemen, you never observed the concept of time management. This exam is about time management because you must, in this case, touch on every question, theories, and the computational. It has been lovely teaching you this evening. I'm looking forward to meeting you in this low-hanging fruits class. Is it tomorrow? See you. Bye-bye. Bye. Bye. It is really yes. Thank you so much. And please market the class on our behalf. Market the class, market this class, your low-hanging fruits. Don't forget to market it. You can see this is not an easy job. It's not an easy job. We will need your support. So we need you guys to market these low-hanging classes here. If you get a friend of yours who wants, in this case here, this kind of classes, especially the busy people, the ones who have not been reading at all, yeah, and they expect to pass. These classes are for them. The busy executives, these classes are for them. Yeah, and remember, I've also requested you to take leave days. When it's 2 weeks to the exam, my students normally take leave days, and then I'll be able to take them through now this program even better from morning. Yeah, you take leave days, 2 weeks minimum. Do you guys have some leave days? You only have 3 days for exams. Do you have some leave days? Do you have some leave days? Yeah, I'll share the marking scheme in the group. Do you have some leave days? Oh, Jonah, we shall overcome. Be blessed. See you in AFM.